Hi, good afternoon. Thanks so much for joining today's webinar, Unpacking the Crypto Regulatory Framework. We couldn't have picked a better time with all that's been happening in the crypto regulatory space over the last few weeks. So thanks for joining this timely conversation. I will be moderating today's discussion. My name is Ala Rubenstein. I'm the Director of Investor Relations and Head of Compliance here at BXE Capital. And just a little bit about us, BXE launched the first digital asset investment firm in the state of Colorado in 2017 and invest in blockchain-centered technologies through a diversified portfolio of cryptocurrencies. Before I go ahead and introduce the speakers, let's just do some quick housekeeping. So everyone's microphones have been muted for the duration of the call. You can type your questions into the chat box for our speakers, and they will address them in the second portion of the webinar. This call is being recorded. If you'd like to obtain a copy of the recording afterwards, we'd be happy to share that. And any information shared today is for educational purposes only and should not be construed as investment advice. So I'd like to introduce our speakers today. We have Joshua Finkleman, co-founder and chief investment officer of BXE Capital. Josh has been investing in blockchain since 2014 and is a well-known speaker and thought leader in the digital asset space. He was governor appointee to the Wyoming Cryptocurrency Advisory Council and served as president of a Denver-based payment services company. And we also have Matt Kaufman. Matt is a partner with Hathaway & Kuntz, a legal practice focused on securities, digital assets, and regulatory law. Matt is a two-governor appointee to the Wyoming Select Committee on Blockchain, Financial Technology, and Digital Innovation. He was co-drafter of multiple Wyoming legislative bills relating to digital assets, banking, business entities, and securities. And he represented the first successful Wyoming Digital Asset Bank charter, the first two Wyoming DAO LLCs, the first Wyoming intrastate crowdfunding offering, and has over 17 years of experience representing tech, financial, and more recently, digital asset projects and companies. I should note that Matt is also a partner of the GP at BXE Capital. So thank you to both Josh and Matt for being with us today. And our format is we will cover several topics relevant to crypto regulation, with Josh offering the perspective as a fund manager and asset allocator, and then Matt will provide his legal expertise on the issues. And I think to start off, perhaps the most timely place to start is with the recent events of the previous week, with FTX becoming insolvent after a bank-like run on its customer deposits, and basically how that's been impacting the market and the regulatory framework. And for those of you who haven't been following the debacle, FTX was one of the largest crypto exchanges in the world, which has now filed for bankruptcy. And its CEO, Sam Bankman-Fried, who was previously called the king of crypto, is now facing federal charges into how he handled the company's finances. And so I think this news has cascaded into different legal issues and led to an escalation of regulatory investigations. And at the same time, I think this has presented a huge opportunity for firms to come together and agree to a set of fundamental core principles. So I can imagine, for example, improvements on liquidity reserves, protection of customer assets, enterprise risk, et cetera. So I want to cue it up with Josh first. Josh, can you shed some light on the impact of FTX from the view of a capital allocator? And then maybe Matt, you can offer your legal take on the issue.
Yeah, thanks, Ala, for that overview and intro. I think it might help to maybe kind of roll the clock back a bit and explain what's transpired this year, right? What has got us to this point and ultimately got FTX in trouble and now filing bankruptcy, and how that impacts the broader space. So back in May, there is a popular smart contracts platform. At the time, it was like one of the top 5 smart contract platforms, called Terra Luna, and it had an algorithmic stable token. And through a couple of different course of events, that smart contracts platform and stable token collapsed. And at the time, the two were about $60 billion. And it's not uncommon, right, in the newness of this space, during stress times that some of these protocols, fail, right? This is early stage technology. And so that had a ripple effect. And essentially it created, when that protocol failed, it created a series of cascading insolvencies in companies that had invested. And so it left essentially kind of large holes in some companies' balance sheets that made them insolvent. And so we saw some of those companies like Voyager and Celsius and Three Arrows Capital become insolvent, shortly thereafter and file bankruptcy. And now we're kind of seeing the second wave of that, right? And unfortunately, it's come to light, and this is a fluid situation, so we don't have all the facts yet, but unfortunately it's come to light that FTX mismanaged some of its customers' funds. They were trying to patch a hole that was on one of their sister companies' balance sheets, and when the public kind of caught word of this, that they might be insolvent, there's in essence a bank run on FTX, and they became insolvent, and now they're filing bankruptcy. And the impact that that's having now is those some of the companies that did business with FTX directly and their sister company Alameda are now having large holes in their respective balance sheets, and now they are some of them are becoming insolvent as well. So we're kind of seeing a continuation of those cascading insolvencies from back earlier in the spring in the May and June timeframe. So the impact that it's had is we're seeing the entire space kind of draw down. There's a lot of fear and uncertainty and doubt in the space. And I think it's really important to highlight that this issue that has come about this year is with centralized companies that are doing business in this space who mismanage their risk management, their operations, and in some instances like FTX, illegally kind of, used their customers' funds. And so this is not a systemic problem with blockchain technology or decentralized finance or what have you, or these protocols. This is what we're seeing is kind of systemic issues and mismanagement with some centralized financial organizations that operate in this space, right? So that's important to segregate and understand. And so the fundamentals in this space haven't changed at all. In fact, to us, what has happened this year is, I think, all the more reason why we push for decentralization, why we push for these protocols where you have full transparency on chain and you can see balances of wallets and debts and what have you, and you don't have any of these issues. And these are smart contract protocols. This is code that you can't game, right? Where people can't collude and make these backdoor deals that end up injuring, a lot of people. And so I think we're seeing, case in point, this reason why it's really important, and why we are pushing these protocols and the transparency of this technology and blockchain technology and away from kind of custodial centralized parties that can mismanage their companies and their customers' funds. So that's an important distinction to make. So that's kind of where we're at, what got us here today. I think right now we're in kind of a peak fear and uncertainty and doubt phase in the market, which candidly we've seen before, right? In 2013, Mt. Gox, which at the time was the largest Bitcoin exchange on earth. And really, back at that point, it was really mostly Bitcoin. And that exchange was hacked and became insolvent. Right. And so there's a lot of fear and uncertainty and doubt at that time. And then fast forward in 2018, the bottom of the bear market, there was a lot of fear and uncertainty and doubt, during that bear market, and ICOs kind of, blew up. And so I think we're seeing that pattern, albeit this time we're seeing systemic issue in the space through these centralized financial organizations that have operated in the space.
Thanks, Josh. And Matt, obviously there's a lot of regulatory consequences to all of this. Where are the priorities right now? What are you seeing in relation to the scandal or issue?
Yeah, thanks, Ala. And maybe just piggybacking off of kind of where Josh left it, I think again, similarly to what Josh was saying about the last cycle, the regulatory conversation has dramatically shifted as well. You know, previously, if you follow the digital asset space at all, you probably heard something about the conversation of whether something is a security or not, and maybe the Howey test is the famous United States Supreme Court case that's often discussed about assessing and analyzing whether something is a security. And so in the last couple of cycles, a lot of the conversation has been around, well, all these tokens, Bitcoin, Ethereum included, are they securities? Are they commodities? And how do they need to be treated in terms of an investable asset for purposes of what regulatory bucket or regime they should fit in? And there's been a tremendous amount of legal work and discussion on, you know, what makes something a security in this context, what doesn't. Does sufficient decentralization of an asset remove it from the securities bucket, put it into a commodities bucket? Of course, you know, the SEC regulates, you know, all things securities and broker dealers. The CFTC regulates commodities and derivatives. And so that was the conversation. And now what we've moved into is the regulation of the market actors and what regulatory sort of rails they can operate under. As we've seen in the United States so far, you know, most of the major exchanges, probably surprises people how they really operate. Most of them operate under, you know, U.S. FinCEN registrations, money transmitter licenses, and things like that. But very few of them have sort of custodial, banking, trust fiduciary type licensure. In fact, very few of them. And so what that's done, and because it's been so difficult for many of them to get that type of licensure, it's driven them offshore. And that's a big piece of this conversation now as well, is with so many of these major global market actors in the crypto space, again, talking about centralized actors being not clearly regulated in terms of their central entity, or their operating authority in the US, but yet what they're dealing in and what they're dealing or selling to customers and consumers might be a regulated security or a regulated commodity or derivative. So again, there's different levels of analysis, and it really matters what that activity is and where they're based with respect to how they're regulated. So we're seeing a lot more focus right now on, and we're going to talk more about this later in the presentation, but what are those regulatory rails that these entities can operate on, both that provide clear compliance mechanisms for these entities, but also on the consumer side, provide some assurance to the consumer or the user that they're dealing with a regulated entity. And then sort of the last bucket, I think that's really important and driving a lot of discussion right now, is the property right discussion around these assets. Again, most people don't know this, but very little law exists in the US or anywhere else with respect to defining the property rights of the underlying digital assets that these exchanges and entities have been dealing with. And what that means is when something goes wrong, what is it that you claim that you own, right? And what kind of property it is may often determine or dictate what your legal rights and remedies are. You know, in this context, again, a huge debate has spawned amongst the legal community of when an exchange like FTX goes under and you're a depositor on that exchange or you hold money on that exchange, what are you? Right? Well, these entities, again, they're not banks, they're not trust companies. You don't have deposit style standing as a consumer or a customer. So in most of these cases, you're literally converted into an unsecured creditor, right? Where when these entities are filing bankruptcy, you are in a long line of a lot of other people claiming an unsecured right to assets that they had that essentially you lent to them. And so again, coming back to how do you define that property right? Most banks and custodians in this country work on a fundamental legal relationship called bailment, a bailor bailee. And when somebody takes property on a bailment, the example that's often used is thinking about taking your car to the valet, right? You give them possession, you give them the keys, but you don't give them the title. You don't give them legal rights to that asset, just to hold it for you for a temporary amount of time and then return it to you. The same is true with these exchanges. Banks are legal bailors of property. They have an obligation to safekeep it and to return it to you upon your demand. And so that line has been blurred with respect to these exchanges and what your rights are with respect to those individual tokens. So a tremendous amount of discussion in that area as well. A lot of it is unanswered questions, and it's going to have to be fought out in the courts, but definitely going to be a defining aspect of this fight going forward.
Thanks, Matt. Yeah, and you mentioned that, well, not only did the priorities shift, but there's different levels of analysis. So I think maybe it makes sense to start sort of on the federal level. Where should we be focusing our energy? What ranks at the top in your view in terms of which items take priority in regulation right now?
Yeah, great question. So I think there's a couple of things. And for those that don't know, there have been a number of federal pieces of legislation introduced in the past few years. Nothing substantial has been completed, but again, I always use my bucket analogy. There's a few different buckets of activity. Maybe the first and the one that's gotten the most traction in terms of engagement with Congress has been the regulation of stable tokens. Some of that was brought about, as Josh mentioned, by the failure of Terra Luna this past year. But also, I think there's been a recognition by at least the SEC and the CFTC and even the Department of Treasury that China is rolling out a central bank digital currency. Other countries are looking at central bank digital currencies. Even our executive order in the U.S. Discussed the exploration of a central bank digital currency. And that technology is the same rollout as a lot of the stable tokens out there, and just the sheer size of some of those stable tokens. Many folks are concerned about the systemic risks that exist there, and so regulating those stable tokens like a bank, like a money market fund or something like that has been a major discussion point. So that's kind of one bucket of activity. Another bucket is what we talked about with respect to defining just clear regulations so that issuers in the marketplace know what the rules are. And by issuers, I'm talking about people that issue tokens or digital assets. Again, the SEC has been largely unhelpful with respect to laying out clear guidance as to what these assets are going to be categorized as. And unlike the securities realm, where if you're a issuer of securities, whether you're a publicly traded or a private company and you want to roll out a securities issuance, what those rules are. There are safe harbor exemptions. There is clear indications of what filings are required, what the conduct of the issuer is that's required to maintain that exemption. And that doesn't exist in the digital asset space. And so a lot of people are just begging for clarity there so that the good actors know what they have to do to be compliant. And then so that's a big piece. I think that will continue to be a big piece. And it doesn't just affect, again, existing assets. I think that's going to affect things for a long time to come so that folks who are developing new projects know how to comply. And then again, sort of that third bucket is the market actors. How do we regulate the banks, trust companies that are performing custodial or qualified custodial functions? How do we regulate brokerages, and how do we regulate lenders? How do we regulate DeFi players? All of these things are going to be major discussions with respect to what regulatory boxes they should be pushed into. And we'll talk about it more in a little while, but Wyoming, actually, where I live, is one of the first places in the country to adopt legislation creating a new type of banking institution just for this purpose, recognizing that in this industry there's a clear disconnect between sort of the traditional best practices and digital asset best practices and the reserve backing that those institutions should require in order to be, safe and sound and regulated. And so a lot of work is being done in that. A number of other states have adopted that legislation in some form or fashion. The Federal Reserve is even looking at chartering those institutions. So there's going to be a lot of talk about safety and soundness, I think, and pushing and forcing digital asset players to abide by kind of those tried and true principles of banking and trust custodianship.
Yeah, and I definitely want to get to Wyoming and on the state level, but first, Josh, as a fund manager, how do you navigate this legal clarity or lack thereof? For example, some of the things that Matt mentioned, being cautious around different categories of assets like stable tokens or third parties or DeFi players. How do you navigate all of this?
Yeah, that's a good question. So one is we really only work with counterparties that are based here in the United States, right? So the United States has probably, the best, at least structure from a regulation standpoint and protection for consumers. And so that's one way you can mitigate that. FTX was based in the Bahamas, right? So as Matt had mentioned, I think some of these players, because of the stringent compliance and laws in the United States, they go offshore and run their companies. And so, we're very careful, and we only work with counterparties that are headquartered here in the United States. That's one. Two is the issue why so many people got hurt this year is because they had left their digital assets on an exchange or with a company like Voyager or Celsius that then, due to mismanagement and poor risk management practices, became insolvent, right? And so, that's how we're seeing all of these, unfortunately, all of these consumers get hurt is by using these exchanges and borrowing and lenders and leaving their digital assets in the hands of these companies. And so when the companies go under, then they lose their digital assets. So we really make it a point to store very little of our digital assets on any counterparty, right? We use a qualified custodian and encrypted hardware wallets and self-custody those assets. And so, we can avoid a lot of this collateral damage just by not custodian our assets with any third party, right? So I think, that is, I think, pivotal, and again, that's why we push decentralized finance, because a lot of these exchanges like Uniswap or SushiSwap or 1inch, they're, non-custodial exchanges. So essentially, you just use the exchange to trade on, and you can't store your crypto on these exchanges. So there's no counterparty risk, right? And so that is the ethos of a lot of digital assets is, listen, you can interact with these protocols, but you can self-custody your assets where you don't have to risk your assets. Whereas TradFi, right? Traditional financial organizations are centralized. And then unfortunately, as a result, you have that third party custody risk, right? That we've seen kind of cascading out, unfortunately, this year and impacting a lot of consumers.
Thanks, Josh. So Matt, getting back to what you mentioned about Wyoming, I know that Wyoming's been pretty progressive in tackling different issues like trusts and custody. And there was recently a bipartisan bill put forward by Loomis and Gillibrand. Can you share a bit more about what's happening in Wyoming, sort of as an example for the rest of the states?
Yeah, absolutely. So a number of years ago, Wyoming, the governor then and a number of legislators decided they wanted to be kind of market leaders with respect to defining friendly regulatory controls and property definitions surrounding digital assets in Wyoming. And so to date, Wyoming's passed about, depending on how you count, 26 or 28 pieces of legislation on this topic. But it really can be boiled down to a few things. I mean, One I already mentioned, Wyoming created a new type of banking charter and trust charter defining, specific legal requirements for entities that want to be regulated in this space and trade. I'm sorry, not trade, but custody and hold digital assets. They can be trading enabled as well, with a whole separate set of standards for, reserve backing and solvency, which, like I mentioned before, that has caught on, and a number of other states have adopted some form of that. And I do believe that that's going to be a big trend going forward, is ensuring that digital asset custodians and institutions are sufficiently reserved and backed. But on top of that, and maybe in some respects more foundational for this industry, Wyoming defined as a property right what digital assets are. And Wyoming did it a little bit uniquely. It divided it into three buckets. There's, digital securities, digital consumer assets, and then virtual currency. And basically decided, right, depending on what issuance the style that the token is going to be, you could utilize any aspect of those three property classifications to sort of determine the legal rights and remedies available to that. And that really stems from the UCC, the Uniform Commercial Code, which most people are somewhat familiar with. That is basically the law of the United States with respect to things like liens and collateral and security interests and all that kind of stuff. And so, again, having that foundational definitional framework so that there is a legal way to maintain a lien, to prioritize a security interest, to foreclose on a security interest. How do you cleanse that security interest? These are all unanswered questions largely. And so Wyoming took a stab at that. Amazingly, the Uniform Law Commission, who's the body that writes all these uniform laws for all 50 states, has come around from a few years ago criticizing Wyoming to now have largely adopted Wyoming's approach and are even adding to it. And that has now served as the foundation for some of the federal legislation we're seeing, such as the Lummis-Gillibrand bill that you mentioned, all of which would really be important, right? Because it takes these definitions and applies them at a federal level. It gives, all market participants access to those types of legal remedies. But on top of that, it does more to help create clarity for market actors as to where the SEC has jurisdiction, when do you need to go to them, when the CFTC has jurisdiction, when do you need to go to them, what about the OCC, the federal bank chartering regulator, or various state regulators. And so again, having that roadmap and having those foundational property questions answered is really critical, and even more critical at a time right now where some of these projects are in shambles and people are trying to figure out what it is they have, and what rights they have.
Yeah, thanks, Matt. Well, and Josh, even though BXE is based in Colorado, just as a fund manager, what kind of policy changes do you hope to see?
Yeah, that's a really good question. So listen, thoughtful legislation can really fix a lot of what happened this year, right? And so these are kind of growing pains, unfortunately, in this space, that we're seeing come about because regulators haven't really kind of come in and built out a regulatory framework around this space so that companies really have best practices and policies. But let me give you a couple of examples of ways that, some changes in policies, and regulations could have probably prevented a lot of what happened this year. You could, require that exchanges in any centralized company that does borrowing and lending, that they are required to show proof of reserves, right? That they have reserves and one-to-one backing on customers' deposits. You could also require that they do proof of solvency, right? Where they on-chain show, hey, these are the assets we have, these are the liabilities, right? Proof of solvent, they are solvent. You can require that exchanges segregate customers' wallets, right? And that they are not able to rehypothecate those deposits and use them for anything. You can have enhanced transparency amongst the centralized players in this space where they have to report on who they are lending to and borrowing from to make sure that there is no kind of systemic risk where one party is, say, borrowing from everybody, right? And if then that party becomes insolvent, then that leaves holes in the balance sheet of kind of all these other companies, similar to what we've seen play out this year. So there are really thoughtful rules and guidelines that can be implemented to prevent things like this from happening. Right. And so we're really, advocates of that and believe that, over time that issues that we've seen, come about this year can be prevented and should be prevented, obviously. Right. But it's going to take the regulators, both domestically and abroad, to, put together thoughtful legislation and get that legislation implemented.
Yeah, thanks for that, Josh. And I'm sure we'll get a lot of questions sort of along those lines, but I do want to open it up for Q&A for our attendees. You can type your questions into the Q&A and Matt and Josh will address them. And I already have a couple here from some of the attendees. One, Josh, this is directed for you. And I don't know if you're comfortable sharing, but what was your exposure, if any, to FTX or Alameda?
None. Yeah, because we do not park our assets for this exact reason with exchanges or third-party counterparties. We had lent out some of our assets back in May and June. They were lent out to earn interest on. And when we started to see the collapse happen with, with Terra Luna and its algorithm stable token, we pulled all of that in from our counterparties. So really, we've been very fortunate and have come out of what happened in May and June and now unscathed because we really have always been very cognizant of third-party counterparty risk and have avoided it.
Thank you. And I guess the rest of the questions, whoever would like to answer, does crypto need a central bank as Yellen claims? Is that the best solution following the FTX collapse?
I don't know, Matt, if you want to handle that or you want me to.
Why don't you go first and then I'll see what I can add.
Yeah. So, in TradFi, the advantage that they have is they have, the central bank, right? So when we saw the great financial crisis, the Fed, the government can step in and backstop the market, right? They can make sure the banks are flush with capital. And so, unfortunately, due to the nascency and kind of the small size of this space, and it's still in its early iteration, we don't have obviously a mechanism like that, right, to come in and kind of backstop these companies. So it's unfortunate. And so, we're seeing some of these companies fail as a result of that. But all the more reason why we need really thoughtful legislation built out to prevent, some of the things that we've seen happen this year, right? And it's completely doable. And again, I just want to reiterate, this is not an issue, a systemic issue with the technology. This technology is continues to iterate and get better and better. In fact, again, a lot of these, digital networks, they're non-custodial digital networks. So people don't store their assets on them. So none of this happens in kind of DeFi, whereas we're seeing this contagion happen in centralized companies that have kind of, either A, mismanaged their customers' funds, or B, just have poor, risk management policies and procedures.
Matt, did you want to add anything?
The only thing I was going to add is to echo something that we talked a little bit earlier about, and I think that's one of the reasons we're seeing a lot of focus on stable tokens too, is just people's recognition and understanding that for the time being, stable tokens provide a lot of the sort of, pipeline for a lot of these transactions to occur, and that ensuring that those are reserve backed and regulated in some way, shape, or form does help mitigate some systemic risk. And I think that we'll continue to see regulation pushed in that respect for sure.
Yeah, and our hope is that given what's happened this year, that will prompt the regulators to really come in and and start to implement good legislation, good policies here domestically and abroad. I mean, we really hope so. We want that, right? I mean, I think if this space is going to grow and become a legitimate asset class, and institutions are going to move in and have exposure to this broad asset class and help further this technology, people need to be assured that things like this won't happen. Right, that there is a good regulatory framework around this asset class to promote it flourishing and to really prevent, individuals or companies from getting injured like we've seen this year.
Yeah, thanks for that. Next question is, are any countries getting it right? What can we learn from El Salvador, China, etc.?
Wow, that's a tough question. Are any countries getting it right? No, is the short answer. Yeah, I mean, definitely El Salvador and China. I don't think either one would be particularly good examples. El Salvador is interesting because they made Bitcoin legal tender, right? So they gave Bitcoin the same status as their, local currency, which is interesting and incredibly bullish on the adoption of Bitcoin and allowing people to have essentially bankless banking. So that's really cool. Don't get me wrong. I'm super big fan of it. But in terms of regulatory clarity for the space, that doesn't really move the needle very much. China's actually gone the other way, right? They have clamped down in many respects on many sectors of activity, specifically with respect to Bitcoin and Bitcoin mining. Of course, they've been aggressive about launching their own central bank digital currency. Most people think that might have something to do with the Communist Party's desire to control and have control over future iterations of technology. So that's kind of different. A lot of people talk about Singapore as a place that does have some regulatory rails that folks can register through. The Bahamas has been another one, Malta, but frankly, there still is not, as everyone might imagine on this call, there still isn't a regulatory regime out there as strong and as well defined as that in the US. And even though the industry's clamoring for more clarity, for those actors that take good faith effort to try to comply, I think we've seen a lot of headway with respect to the US. It's just going to take time. I mean, technology moves fast anyways. This technology is moving super fast and it's way ahead of the law. People get frustrated, but we like our legislatures and Congress to move slow for a reason so that they don't screw things up. In this case, it'd be nice if they moved a little faster, but I think it's coming. There's a lot of conversations happening, and these events, for good or for bad, have gotten a lot of people's attention.
Well, and I think that folds nicely into the next question here, which is, since crypto is borderless and globalized, how much does US regulation really affect the global crypto markets?
Yeah, maybe I'll start with that, Josh, and then you can clean up what I mess up. But I mean, I would say, again, a couple things. Think about the US regulatory scheme in two ways. One, we regulate the instruments themselves, right? The tokens or the securities or the commodities. But then we also regulate the market actors, and depending on how they interact. And again, I think where we have made some real headway in the industry is people wrapping their heads around the ways in which tokens can be defined as a security or a commodity or something totally different. Some of the legislation we referenced earlier, the Lummis-Gillibrand bill, actually creates a new type of digital asset. They call it an ancillary asset, but it could be a governance token. It could be a number of things. But that regulatory clarity is definitely needed just so we can take these existing assets and fit them into traditional regulatory law and frameworks and rights remedies, et cetera. So that part I'm actually fairly optimistic on, that people are making headway. The other piece of it, though, and what we've seen from all this, is regulation of the market actors and making sure that there's transparency. Again, I referenced President Biden's executive order. One of the focuses of his executive order was consumer protection. And I believe that that's going to continue to be a big theme through all of this. I was just telling this story actually yesterday, funny enough. I interact almost daily with banking regulators. And I was telling them that, when I was an early customer of BlockFi, and because I work so much with banking regulators, I did a deep dive on BlockFi to try to find out on my own what licensures they had. And I couldn't decipher what licensures they had and couldn't really tell if they were regulated at all. And the regulators were kind of laughing. They're like, that is the problem in this industry, is both the trust, but also, the ability for technology solution providers to sort of look like institutions, regulated institutions. And that's going to have to change, and that's going to have to be a regulated thing. And I to echo Josh's comments, I don't think that's a bad thing. Right now, a lot of the heartburn in this space has come from bad market actors. So creating some tighter rails for them is not the end of the world.
Josh, did you want to add anything to that, or?
Yeah, I mean, I think Matt has a much better handle, obviously, on the regulatory environment. I would say this, it's not uncommon that a new industry kind of front runs regulation, right? And gets ahead of itself. We saw that kind of in the early days of the internet. This is still very much the early days of this technology and this asset class. I mean, the asset class, the total market capitalization, the asset class is just a mere 850 billion. It's tiny. And so I think what we're seeing is the asset class, the tech got ahead of itself, right? Got ahead of that regulation. And so it's not surprising to see kind of these blow-ups periodically that will hopefully be catalyst for, improved regulation around this space, right? That I think ultimately is beneficial and is needed. But, I'll say in the interim though, there are good centralized actors, right? There are exchanges that have for a while now shown proof of reserves and proof of solvency, and are very transparent and are operating their exchanges, I think all within the context of the law and doing the right thing. So, you understand that. I mean, many of you have probably heard the term like not your keys, not your crypto, right? When you give your private keys, to a third party counterparty, they aren't yours anymore. And if that company goes under, then you lose your crypto. So it's always just a good practice, maybe, to either use a third party counterparty that is transparent and shows proof of reserves, and is highly, is regulated in the United States. But it's always, I think, the best practice of just to store your own crypto, right? Take it off these exchanges and self-custody. And then you can avoid really all the calamities that we've seen, unfortunately, come about this year.
And I think we have time for one more. And again, this is open to Josh or Matt, but what are your outlook for ETFs?
Well, there's ongoing litigation as we speak with respect to specifically Grayscale, Bitcoin Trust seeking to get an ETF conversion. This area of law isn't my strong suit necessarily, but I've done some deep dive, and I've spoken to some really knowledgeable people in the space. One of the problems that they're having is that because of crypto's nature and the 24/7 settlement aspect of it, it makes it very difficult for regulators to track the daily NAV and protect against sort of NAV, the net asset values of these ETFs in sort of a market captured way. I mean, a lot of mutual funds and ETFs have reporting obligations, on daily, weekly bases where they have to mark to market, and then there's again reporting obligations that they have to ensure that there's no internal arbitrage happening. That's been one of the major holdups with respect to crypto spot ETFs, is just the 24/7 nature, and how does that fit with our regulated market structure? for securities, which have, tight trading hours and settlement rules. And so there has been some movement in that regard. Some people have heard that FASB, the Financial Accounting Standards Board, has released some updates that are looking favorable for Bitcoin and how Bitcoin is going to be accounted for on companies' balance sheets. Things like that start to add up really, really importantly for how the SEC, who even relies on FASB guidance, and how they look at those definitional sort of differences between this technology and sort of traditional ETFs. So I'm of the mindset that I think we're going to get there, but we're not there yet. It's still going to take some additional legislative intervention, I think, or a court to sort of slap the SEC or somebody and sort of force their hand. But we'll see. There's a number of attacks on those different fronts occurring right now, and maybe somebody will get some headway here soon.
And we're close to time here, but Josh, did you want to add anything else on your outlook for ETFs?
Yeah, I mean, I think, we still have yet to get a spot Bitcoin ETF approved in the United States. So it just gives you a reference point as far as how far we still have yet to go, right, on the regulatory front here in the United States. I mean, they're unfortunately just, again, due to the newness and the nascency of this space and the technology that's broadly misunderstood, I think there are very few really good investment products available to institutional investors in the United States, just because there isn't enough legislation built out. There aren't enough different types of alternative, investment vehicles afforded to retail investors and/or institutions. So it's indicative of, really how far we still have yet to go in the regulatory environment, both here domestically and abroad.
Yeah, and to echo that, it's clear from this conversation that there's just so much potential, and positive changes to regulation are clearly welcome. So thank you all to our attendees and to our panelists for joining us today. Thank you, Josh and Matt, for giving us your insights. We will be sharing this recording with attendees after the call if you'd like a copy. And for any questions that we didn't get to, you can always write to us and continue the conversation, ir@bxecapital.com. Thank you all so much.
Thank you.
Thanks.